Hey, there we are. How's everybody doing out there? We're still getting used to this new software that we're working with for our live stream. See if this can work out. We should have a better picture than last week. I've got my green screen up behind me. So welcome to Oregon Cash Flow Pro. We're here to do live whole life illustrations and policy reviews. Live whole life illustrations and policy reviews. I did have somebody after our last one send me their current whole life policy that they had set up to do infinite banking with. And he said he'd be happy to share that with us so that we can take a look at it and see how it stacks up, see how it was designed, talk about it. We're reserving Tuesdays. We're going to do live streams to do live IUL illustrations and policy reviews, and Thursdays for whole life illustrations and policy reviews. So if you have any interest, join us on those days. If you want to see some different designs, if you have some questions about particular carriers, that's the time to bring it. Everything we do here is about transparency and just trying to open up this world to everybody. We're not only helping clients, we're also helping other agents. A lot of other agents watch this channel and hopefully learn a thing or two about designing better policies for their clients. So I'm really glad to see that we're having an impact, not just with the clients that we reach individually, but also with the reach among agents, showing them that we can do better. We can design better policies, and it's just good for the industry, in my opinion, if people start getting policies that actually meet their needs. It's really disappointing to see poorly designed policies. I'm not even talking about a reduced commission, but like sometimes policies just do not match a client's expectations. It doesn't match what they need that policy to do. And ultimately, the costs end up being way too high for what they're trying to accomplish. And so it's disappointing because you end up with somebody who doesn't like it. And as you know, in the marketplace, it doesn't matter what the product is, complaints reach way more people than stories from satisfied customers, right? So we need to make sure that we're creating good stories out there. People want to tell other people about this great product that they bought and how it met their needs and how it was everything that they were hoping it would be. That's what I want to see. So I'm really happy that we're getting the audience that we have, and educating folks beyond just people that I work with personally. So is the sound coming through okay? I did have a problem with sound with this last week. Two of the recordings I did were good. One of them was like really bad. So if you can let me know in the comments if the sound is coming through good, I would appreciate that. And then we'll dive into this policy that somebody sent. I think I'm going to hop on YouTube, see if I can hear it for myself. All right, let's see if we're getting some sound. And it looks like we are. All right. So we'll keep this going. Visuals look good. All right, what's going on with my software? Oh yeah, it's over here. Okay. Thanks. Make smart. Appreciate that. All right, let me see. If I can get this set up. We're going to do screen share. I don't want to do the entire screen there. Let's see if we can do that. Okay, so I'm working. When you see me looking away, I'm looking at my software where I can do this switch. And we should be up. How's the visuals look? Okay, we can read that. Let me see if I can expand it a bit. All right. Everybody see that? So we've got a Mass Mutual policy. Let me tell you what the client said. Sorry, this is not my client in this policy. This is a policy he bought from somebody else. He said, let's see. He's a recently licensed agent himself, just getting his appointments and contracts. Let's see, plans on tuning in and learning more from me. He will attach his first IBC whole life policy with Mass Mutual to this email. Find it in case I find it of value to use in a case study design. When he contacted this agent to design the policy, that agent was very unfamiliar with IBC and blending a whole life policy for purposes of overfunding it. He's happy with the policy so far. Can't find anything bad with it other than the blend isn't as great as some of the designs geared for 90% access to cash value. Also, we noticed the premiums do increase as the policy ages due to the AILR, which is the additional life insurance rider, being he believes a 10-year RTR. He intends on doing a reduced paid up at some point before these charges skyrocket. It would be great if you could maybe shed some insight or some criticism you might have overlooked. He's going into his third year with it, and it's performing decent. Okay, Eric, if you're looking, if you're with us today, let me know, because I would like to know what performing decent means. That can mean all kinds of things. Is it matching your original illustration? Is it outperforming, or is it underperforming? And then by how much? If it's one of those, if it's overperforming or underperforming. So just curious, if you bought it 3 years ago, dividend rates have basically held steady. So I imagine it's probably close to what it was illustrated, but it'd just be good to get confirmation. So this should be his original illustration. Let's see, is there a date here? October 30th, 2020. So we have a date. This is Mass Mutual's L100, Whole Life Legacy 100. This is a great product for cash growth purposes. You can do a nice blended design to bring the commission costs down. When we do a blend, what we generally like to see is a blend of LISR and AILR. And I don't see any LISR with this one. We do see AILR. And that's okay, but when you blend in LISR, it does add a little bit more flexibility. So that probably has to do with why you see those charges increasing later on. Because we generally don't do the RTR rider to get there. The AILR is not the RTR rider. Those are two different things. So you can see right here, you've got some AILR scheduled coverage amount, and then you've got your RTR face amount. So those are slightly different. And the LISR is another term coverage. And the blend of the two is key for giving us some flexibility. Mass Mutual is not very flexible, but it gives us some flexibility, and it allows you to make very high payments in relation to the base for a long, long, long time, if that's your goal. So that's one of the nice things about this particular policy is you can make a very high premium payment in relation to the base, creating good cash value for a long period. So we see our policy base face amount of 125. In general, with Mass Mutual, you can do a blended design of 3-to-1. So you could have a total death benefit of basically 500,000. You're at 400,000. So this is not bad from that perspective. This is my first time looking at this too. He sent this to me last week, but I didn't get a chance to look at it. So you're seeing this right now at the same time I'm seeing this. My expectation is when we get to the dollar amounts, I'm guessing the cash value in the first year is probably going to be in the 70 to 80% range. Let's take a look. And an ideal blend back when this policy could be designed, this was before the recent 7702 changes, you could get 90% cash value in year one. So his MEC limit is 12,246. And he's funding it at 6,000. So I'm wondering why he has it set with a MEC limit of 12, even though he's only funding it at 6. Let's see what the numbers actually say. Maybe he is max funding it down here. Mass Mutual is one of the carriers that there's not a whole lot of flexibility. That if you're going to fund it at 12,000, set it at 12,000. Like your scheduled premium should be 12,000. If your scheduled premium is lower, which is what we're seeing here, the scheduled premium is lower than the MEC limit. If you want to increase what you're paying in more than, say, 10%, you might have to go through some underwriting to make that happen. Okay, so I see what you're talking about, how it increases. That's likely the cost of that term insurance increasing each year. If you were maxing this, if you were putting in the max, you wouldn't see this go up. The underlying minimum would go up in order to cover those costs, but this wouldn't necessarily go up. This is the guaranteed column. Let's go to the non-guaranteed values. Oh, sorry, non-guaranteed over here. Yeah, so it holds steady here because it's assuming you're getting some growth. And on this side where you're not getting growth, but the cost of insurance goes up because it's the annual renewable term that's added to this, you're seeing that go up. That's the difference between this side and this side. Cash value, here we go. Total cash value year one. Let's see what those numbers do. So 5,002 in cash value, and we've put in 6,776. 73%. So right where I was expecting. Between 70 and 80% was what I was figuring. This is not max funded though. If this was max funded at the 12,000, we would probably see this closer to 80%. So it's not an optimized design, but as he suspected, it's not bad. I think ultimately this policy will do just fine for what he's looking to do. He mentioned he wanted an IBC policy, which is infinite banking. And to do infinite banking, we just need cash value. So as long as these cash value numbers meet his needs, he can use this for infinite banking. This is essentially a line of credit that he has access to for the rest of his life. And the greater he can fund it, the more he will have access to. It has good guaranteed growth. You get the dividend rates. When you first start your policy with Mass Mutual, you get to choose whether you want non-direct or direct recognition for your loans. I think the default goes to non-direct recognition, and that's generally what most people would choose. So the rate can go up to generally like a max of 8%. But it's in the 5% range as of today. My policy is still at 5%, but when it renews in April or May, whenever that, I think it's in April, I think it'll go up to whatever the current rate is, which is probably in the mid to high 5%. Although by then, maybe the Fed raises the rate again. Maybe it'll be a little bit higher. So this is not a bad design. Let me go over what we're looking at here on these columns. So here at the top, we've got our base policy of insurance. I touched on this a little bit, but let's dig a little deeper. $125,000 is your base face amount. This is what the whole life portion of the policy is built with. Annual premium $1,548.75. The commissions on a policy like this are mostly based around this base amount. The lower you get that base amount, the lower the agent gets paid. Okay. But it also helps to determine how much can you put into this policy. So that's the thing with whole life policies. When we're trying to design these, if we want as low a cost as possible, in general, we want to see a lower base premium. But we still have to be able to fund it at the level that we want to fund it at, which is generally limited to maybe 10 times the base. Okay, next we have our scheduled AILR. This is a term blend. It's not showing any face amount here because it's holding all the term in here for cost. Although that AILR does buy some death benefit, which when we were back at the beginning, I'm going to shift back to that. When we get back to the beginning, right here, you can see the AILR coverage amount is $24,000. This is essentially your paid up additions. Okay. That $5,000 is buying $24,000 of whole life, permanent paid up additions. And because they did this blended design with the RTR, this is not replacing the RTR. Here's our renewable term rider. Provides a level amount of term insurance. It's renewed automatically each year until the policy anniversary nearest the insured's age 95. So it's annual renewable term insurance with level premiums for the first 10 years and an increase on renewal after 10 based on the current rates. So it's like a level term for 10 years and then annual renewable term after that. There is a schedule of increasing guaranteed term charges set at issue that are reflected in the contract premium for guaranteed values on the illustration. Current charges are shown in the non-guaranteed contract. So they're reserving the right to increase. They're saying the premiums are level for the first 10 years, but they're reserving the right to increase it, which is why under the guaranteed column, we saw that cost go up each year. A little bit confusing. Sometimes these things are. I basically assume it's not really level, or at least it's not guaranteed to be level, right? Most of the stuff we want to deal with are around what can we expect from a guarantee? So this is not generally how we design a high cash value policy with that RTR. We use the LISR instead. But there are different ways to go about this. So in this case, this used that RTR. That's why we see on the non-guaranteed, premium holds steady for 10 years, and then it starts to go up. So if he wants to keep that RTR tied to the policy, the cost of that RTR is going to go up, and he'll likely need to either put in more money. You won't have to put in more money because that money can come from your dividends or can come from your cash value. Okay, you should have some flexibility in that regard. Now, if you decide to do a reduced paid up, you don't have to worry about any of that. You can always cut that term rider, and then it should just drop down to your base They might let you put in some paid up additions above the base, just not as high as you would be able to if you had that RTR tied with it. Because you need that RTR to have the mech space. Okay, so back to this. We've got the renewable term rider for $250,000. We can see the cost of that, $227.50 annually. Now, this breaks down the cost if you were to pay semi-annual, quarterly, and monthly. MassMutual charges you a bit if you want to go anything other than annual. So take a look. If you pay annually, the total $6,700. If you pay monthly, that's like 5% higher. $300 extra you're going to pay to go monthly as opposed to annually. That's kind of significant. That's a kind of a significant charge. And if you have a bigger premium amount, those numbers end up being higher. I mean, it's not very attractive in general to pay monthly with a MassMutual policy. Sometimes you have to do it, and that's fine. But if you're getting into a MassMutual policy, if you can make an annual payment, I do suggest you make an annual payment. Next, we've got the initial modal premium. That's the amount you're paying in. And then, of course, the breakdown depending on when you want to schedule those premiums. Now, MassMutual does allow you to adjust what you're paying in, but it's only once a year on your policy anniversary. And it's up to a certain amount without underwriting. So if you're young and healthy and you want to make some changes to this, do it while you can still go through underwriting and get an approval from them. I highly suggest any policy that you own, try to max fund it. That makes the best use of this policy because your underlying costs are essentially the same whether you're putting in the $6,700 or if you max out at the $12,000. $12,246.16. So you want to try to max out. You can talk to MassMutual, find out how much space you have. They might let you catch up over the last year, maybe for the couple of years that you've missed. But if you go a couple more years, you may lose the ability to increase it or the ability to catch up. So that's some of the things you got to worry about with MassMutual. Their catch-up contribution rules are a little complicated. In general, I like to use MassMutual if we're not looking for flexibility. If we expect that we're going to be able to make our annual payments and we don't need to adjust those up and down year to year, because I don't want you to lose the ability to be able to stuff in all of that extra cash. Does that make sense? Okay, so this gives us a couple of other columns that we can look at. Oh, wait, those columns are still up here in this one. Let's go through these real quick. So we've got our guarantees over here, and then we have our non-guaranteed values. The guaranteed values assume no dividend every single year in the policy. You still get your guaranteed cash growth. So you're going to see that cash growth go up. Your cash value is going to increase. Your death benefit's going to increase. But it's only at the guaranteed amount. And then back when this policy was started, it should have been a 4% guarantee. The current guarantees for this product, I believe it's 3.75%. MassMutual got a little confusing after the 7702 changes. Some of their products guarantee 3.75, some of them guarantee 3, some of them guarantee 2. And all come with different load fees. So something to be aware of. It's just a little bit confusing. The non-guaranteed column is going to assume the current dividend rate every year. So we've got our contract premium. This is the dividend based on that. The dividend is basically paying based on all of those paid up additions we've put into this policy. Because in a base policy whole life, you generally don't get any dividends for the first couple of years. Okay. But we should see these dividends go up every single year. Those dividends are not just all of the growth in the policy. I mean, it's not all of the growth in the policy. This is usually above and beyond whatever the guarantees are. Okay, so we see a dividend of $219, but what happened to our cash value? Our cash value is $5,002 here. Goes up by $5,000 here. Let's go down a few years where it makes more sense. So right here, we have an $83,000 balance. You see, this has a dividend of $1,500. But the next year, we pay in $7,000, and our total account balance went up by $3,000. That's more than what we see in the dividend column. That's because of the guaranteed growth. The guaranteed growth is happening here. It's not broken out into this dividend column. This dividend column is the excess. It's above and beyond whatever the guarantee provides. Okay. And then this column, we have our cash value additions. End of the year, this is your paid up additions. Okay. So then we have our total cash value. This is your surrender value. If you ever want to close your policy and walk away, this is that number. You'll have a slightly lower amount that's available for policy loans. So this is what I like to also view as your potential line of credit. This is what you're building up when you're doing an infinite banking policy. You're building up a line of credit. Oh, here's our paid up additions. And then we have our total death benefits. So this is the cash value of the paid up addition. This is the death benefit of the paid up addition. And then we have our total death benefit. Okay. Correct. This column over here is the non-guaranteed cash value. Over here, you have the guaranteed cash value. So one of the nice things about these designs, when we do a proper blend, the cash value, even in the guaranteed column, break evens in a reasonable period of time and does substantially well. I mean, we're not looking at this as an alternative to a stock market investment. We like to look at whole life policies as an alternative to a savings account. Basically, money that you might keep in your emergency fund, capital expense account, basically money that you have on the side that might be waiting to be invested. This is a great place to store that because it's going to help provide you a death benefit, but you're also going to get tax deferred growth on a guaranteed basis. You should get more than that, like Mass Mutual, Guardian, Penn Mutual, the three that we like, have been paying greater than the guarantees for 150 plus years. So I think it's safe to assume those can continue, but there's no guarantee, right? So looking at the guaranteed columns, we get a good idea of like, what's the worst case scenario? Your guaranteed column is no dividends ever and the highest cost of insurance. Okay. So we should see a substantial difference the further into the policy we get. You know, here by year 20, that's a $40,000 difference between what's possible based on the current dividend rate and the current charges and the guaranteed. Now, this is 20 years of approximately 8,000 probably on average over that time. So this is almost or right about break even after 20 years. That's also an indication that this was not an optimally designed policy. Generally, our optimally designed policies under the guaranteed column, we see a break even with Mass Mutual, I think around year 12 or so. With Guardian, we generally see it around year 10 or 9 or 8. It's substantially sooner. And in this one, he's near year 20 for that break even on the guaranteed basis. So not too bad. This is not too bad I think you'll end up being happy with it. I definitely wouldn't cancel this policy in order to start a different one because the differences are not gigantic. Like if you did an illustration with this in an optimally designed policy expecting to change, like I would just max fund this one. You're better off max funding this. I don't think it would be worthwhile doing a 1035 exchange into a slightly more optimized design. There's a point where it just doesn't make sense to go through the hassle of doing something like that because you're basically starting over with the policy, right? And this one is not a completely terrible design. It's just not optimized. Let's see if there's anything else that we can glean from this. Yeah, if you sent this to me for a policy review as a client or a potential client, I wouldn't be advising you to change this. They've got to be really atrocious, usually. It also depends on how long you've owned it. But like, generally, we would run the numbers and see. I don't even think I need to run numbers to see how much better this could be if it was optimally designed. Also, at this point, if you were to switch it, you would be changing from a 4% guarantee to a 3% guarantee. I think there's a lot of value in having that 4% guarantee. Certainly more so than just increasing the cash value a little bit more. Joe says, all those values tax deferred growth, no need to pay taxes for dividends, right? Correct, if you access it in a certain way. So like if you actually withdraw the money, which you can, the cash value that's in your policy, you can just withdraw all of it and walk away anytime, okay? If you do that, you're going to pay taxes on the gains at that time. The dividends, however, are not taxed. The dividends in whole life are considered, for tax purposes, a refund of premium, even though we know at some point you could have dividends that have been in excess of all the premiums you've paid at some point. And that's what we look for in these things. So clearly it's just a tax designation that it's a refund of premiums, because how do you get a refund of premiums beyond the premiums you've paid into it? How is that still classified as a refund of premium? I think it's just kind of a loophole that life insurance gets to enjoy to keep things simple. You don't get taxed unless you pull the money out. So it's tax deferred. If you access it through policy loans, you don't pay any taxes. It's just like taking a mortgage out on a house. We don't pay taxes on that because we're borrowing the money. It's not an actual income. So why would you pay taxes on it? These get treated the same way. If you just borrow, you're not going to pay any taxes. Now, generally in whole life, we'll withdraw up to the basis being how much you've paid into the policy, because you can do that tax-free. And at that point, we start the borrowing process until we pass away. Now, you can borrow in the early years, use it just like a line of credit, you plan on paying it back, right? But at some point in retirement, a lot of people plan on accessing the cash value in their policies to help supplement their retirement income. And that's where we generally look to withdraw first up to the basis and then shift to policy loans. All right, so let's see. Everything else looks pretty normal for a Mass Mutual policy. Yep, you are using the adjustable rate loans. You can see loan rate, adjustable. Let's see. This does illustrate in one of those supplementals a reduced paid up. So it looks like your plan originally was to do a reduced paid up. Here's our reduced paid up values. Let's take a look at this. So this is showing the reduced paid up happening after year 10. So you're making 10 years of payments, then doing the reduced paid up option. That means you're not putting any new money into the policy at that point. And this is the potential growth. So total cash value at the end of the year. Let's go year 20. So at year 20 in this scenario, you didn't put any new money into the policy. You're at 113,000 in potential cash value based on the current dividends. Back, if you didn't do the reduced paid up and you kept contributing, because you don't have to do a reduced paid up just because it illustrates it in here, that is not something that happens automatically. So policy year 20, when you didn't do a reduced paid up, right here, total cash value 198. So the difference $75,000, $85,000. $85,000 difference. But how much extra did you pay into this policy over those 10 years? Oh, right here. About $70,000. 71, yeah, about $71,000. So you paid in 71 and you've got an extra 12,000 to show for that. Now, if you're max funding this policy, that will do better. But that's okay. 12,000 bucks over the course of 10 years. Now, obviously, that's 10 years of compounding on the first 7,000 that went in, 9 years of compounding on this one. So that's not bad. Those are decent numbers for sure. So my preference is to assume we're probably going to keep making payments on this thing. And the cost of that term insurance is actually still pretty cheap. You can see it only goes up by a little bit. About 10 bucks a year here that it's forcing this to go up to keep up with that rising cost of that term insurance. And at some point, you're just going to cut it off. But the term insurance doesn't usually get expensive until you get into your 60s and 70s. So in this case, the cash value continues to accelerate pretty well. On the current illustrated, this whole entire time, can't tell at some point here if it cuts off that term, but it doesn't look like it does. Because you can see it's making you put in a lot more money in this scenario. Now, you said your plan was to cut it off. And that's fine. Yes, you will avoid being forced to put in a bunch of extra. Okay. And I think you'll ultimately be happier with this policy if you do max fund it earlier on. Most likely, if you max fund it earlier on here, you're going to be in a better position to keep max funding it probably until year 20 and then look to cut off that term insurance sometime around there. Or do the reduced paid up at that point. The thing with the reduced paid up, the only thing to remember is that if there's any other riders that you have attached to your policy, those likely go away. A reduced paid up just reduces the death benefit. It reduces the cash value. Sorry, it doesn't reduce cash value. It reduces the death benefit to an amount that the cash value is considered the death benefit to be paid up. It's just a death benefit at that point. So any other riders likely go away and you just have that death benefit. So if you have other riders, like with Guardian, they have an index rider, an index participation rider where you can kind of use it like an IUL. If you do a reduced paid up with that policy, that rider goes away. You don't have the option to use that anymore. So if you want the option to use that rider, don't do the reduced paid up. Joe, you like this one compared to the IUL? Cool. Yeah. So for some people, they're going to gravitate towards whole life to meet their needs. For some people, they're going to gravitate towards IUL. I definitely look at them to meet different needs, but I like both of them. As long as we design them properly, they can be good. They can be good financial tools. And of course, we're looking at them to supplement all of our other efforts, investing in the market, buying real estate and having rental real estate or whatever other investments that you're in. Invest in businesses. Obviously, there's a lot of choices out there. This is just something to supplement them. That's how I view it. Now, you can use these like the and asset. We can use the cash value in these to make other investments. And that's oftentimes the best use of the cash value in these, is if we're using it to buy cash flowing assets or appreciating assets, so that we're still having that guaranteed growth in here. We're getting growth on those funds outside of here that can be used to pay off these loans. And at the end of that period, once you pay that loan back, now you've got that cash flowing asset and you have all the cash value back in your policy. Like, that's like the best way we use lines of credit, right? We don't want to use a line of credit to go out and splurge on a night on the town, spending all of our money on booze, right? You don't have anything to show for that except for a big bill at the end that you got to pay back at some point. Terrible use of your money. We're going to look at this the same way. This is our money. You know, when you use money out of a line of credit, that's cash. A lot of people don't view line of credit or credit cards as cash. They think it's just available for spending. That is a bad habit to get into. We're going to treat our cash value in our life insurance policy just like it's cash, because that's what it is. That's where we're storing our cash when we're not deploying it somewhere else, right? So treat it that way. That's why we call it our infinite bank. We're going to do our banking. We're not going to be able to use it like an actual bank. We're not going to make daily withdrawals and deposits, right? That's a little more complicated than insurance companies want to get into doing. But essentially, you can have access to it, you know, borrow from it a couple of times a month if you need to. You can do more than that if it's really necessary, right? But the insurance company is not the ideal institution to do that type of banking with. That's what banks are for. And in general, our banks serve a decent purpose for moving money quickly and efficiently. It's going to be slower moving money in and out of life insurance. With Mass Mutual, they'll still mail you a loan check. So you know it's going to take you a few days to get the money. All right, I think that's it. I don't think we have anything else we can glean from this. This is a well-designed policy, not optimized, but well done. It looks like it will meet your needs, Eric. And other than suggesting that you max fund it while you're still young, see if you can get that increased. You'll probably have to go through underwriting with Mass Mutual, but if you can afford it, I would suggest max fund it. Joe asks, when you need cash, how soon we have access to it? Will Mass Mutual give money within 1 or 2 days or 10 to 15? Good question. So I touched on that briefly, but Mass Mutual, you put in your loan request. If it's not money that you just sent in, so like if you've just made a payment into the policy that creates cash value, and then you request to borrow out that exact same dollars, there's going to be a hold on those funds, and that's a 10-day hold. If you've already got the cash value in there and you send in a loan request, they drop a check in the mail like the next day. So depending on how quick mail gets to you, it might take 3 or 4 days, right? It might take 5 or 6 days, maybe around holidays, might take longer, right? You're definitely at the mercy of the postal service. You get a company like Guardian will direct deposit it into your account. That's generally in my account when I do a loan request with Guardian in a day or two. I've seen it the next day. I've also seen it happen in 2 days. Not generally longer than that, unless it's on a weekend, right? So business days. It can be fairly quick. I expect all insurance companies will move to that at some point where they'll just automatically deposit it, because why wouldn't you? It's got to be a lot less expensive. At the same time, though, the easier you make it for people to borrow, the more people are going to borrow. I think Mass Mutual, the percentage of people that borrow from their policies is very low. In general, whole life, I think the percentage of people that borrow from their policies is very low. But I imagine it's lower with Mass Mutual because they have that small barrier. It's not quite as easy. It's not quite as quick to get the funds. So you're not going to treat it like an actual bank. It's definitely easier and quicker to get it out of Guardian, but we're still talking a couple of days, 2 days to get it in, 2 days to get it out. If you want to borrow from those same funds, you've got that 10-day hold. Okay. So those things are going to vary, but in generally, you get your money pretty quickly. So if you watch my videos on I don't know if I have a specific video on it. I've definitely touched on this, but how I treat emergency funds. Your emergency fund, you might have some money in cash on hand, $1,000, something that you might expect to be able to cover any need for cash if like the power goes out. If it's an emergency, let's say there's a climate emergency, power's out, you've got to buy water, you've got to buy gas, whatever. You need to have cash because credit cards may not be working in that situation. So cash for immediate needs. Then we have a little bit more money that we have access to within hours. Okay. So you got a great deal on a car, but they only accept cash, and you happen to have that money in the bank. You could just run down to the bank, pull it out. You could go to the ATM, you could pull it out. Okay. You can write a check and it's going to come out of that, right? Something where you have access to it in a couple of hours. That's our next level of our emergency fund. Then we've got money that we need access to within a week. Okay, we may not need access to it immediately, but we know it's coming up. Those needs can often be met with lines of credit, credit cards, even some of the things that like you need money within an hour or two can be met with credit cards. So we don't necessarily need to be sitting on a bunch of cash in our checking or savings account, not doing anything for us. Our emergency funds are generally like 3 to 6 months of expenses. So if we know we can get access to the funds in our life insurance policies within a few days, anything above that few days need, we can store in our life insurance policy. So that's how I like to view that. Matt, you've got Mass Mutual check electronically. Oh, excellent. How did you do that? I haven't seen that option. I have a Mass Mutual policy. I haven't seen that option to get it electronically. Joe says direct deposit's good. Don't know why companies in the USA still send paper checks. Even developing countries like India does all electronically. I don't get it either. I think insurance companies are just in generally very conservative and slow moving. And I do expect them to eventually move to that. But they're a good, solid business. They're not required to stay on the cutting edge of technology. Staying on the cutting edge of technology oftentimes requires disruption, extra upfront costs. That's the only thing I can think of as to why they might be slow in migrating to that. We do tend to see some smaller carriers that are definitely more advanced in that regard. And I think they need to do that. Like they need that draw. They need that advantage, the technological advantage, because they don't have the size and they don't have the history to compete with some of these other carriers that frankly don't need to do that. So that's what it looks like to me. So Matt, let me know how you get your electronic distribution from Mass Mutual. I'll check it out because I need to look at setting that up for my Mass Mutual policy. I've just recently switched from an insurance-backed line of credit with Bancor back to the life insurance companies. So collateralizing my policies outside of the insurance companies was great for a couple of years there while rates were low. But in this rising interest rate environment, rates jumped up. So now it's cheaper for me to get my loans from the insurance companies. So I switched back. So I will be looking to get access directly from those carriers. So if I can get that electronic check from Mass, that'd be good. So we're done with this illustration. I'm going to say next, we're going to wrap this up. Next Thursday, let me switch this back here. So next Thursday, we'll do this again, and we'll do an illustration. So if you guys want to see any particular carrier, let me know. You can always recommend it at that time, that day. So if you're there, you can say, hey, can you design this scenario? And we'll just put it together. So Tuesday, we'll be doing IULs. Thursday, we'll go back to whole life. And I'm going to use one of these weeks where I'm going to go over my policies because it's time for an update. So I've got a Guardian policy that just renewed. My paid up additions payment should finish processing, and we'll be able to do a review on that one, see where that one's at. I'm really close to break even. My IUL policies, I don't think I've had any recently renew, but I think I need to do an update anyways on my National Life IUL. And so we'll do that on our IUL days. So that'll be one of these Tuesdays where we'll do some updates on my policies. So appreciate you guys joining me today. Good questions out there. Thanks, Joe, for those great questions. And I hope to see you guys again in the future. I hope you found some value in the content we provided today, maybe mildly entertaining. And if so, hit that like button. Make sure you're subscribed so you can get notified when we're live. And we will be back again soon. So thanks for joining us. We'll see you guys next time.